Hi everyone, I'm Andrew Murphy from Winthrop Wealth. Welcome to our first quarter 2021 market review and outlook. Full written version, which goes into a bit more detail, is now available on our website at winthropwealth.com. Of course, the world looks quite a bit different than it did at the beginning of last year, and we hope that we are on the verge of entering into a brighter period. And while we have been mostly virtual since the pandemic started, some of our employees have returned to the office, and we were able to meet with a few clients in person over the last several weeks. We are committed to providing customized and proactive wealth management solutions, and above all, helping you live life to the fullest. Please let us know if you have any questions, and we look forward to speaking with you soon. In today's video, we'll discuss interest rates and go over the fixed income and equity markets before providing context for our outlook and portfolio positioning going forward. Let's start by taking a look at what was probably the most important development in financial markets during the first quarter, the increase in long-term interest rates. And this chart shows the U.S. 10-year Treasury yield, which increased from 0.91% at the end of last year to 1.74% at the end of the first quarter. If we go back a little bit further, the 10-year has more than tripled after increasing from an all-time low of 0.51% in August of 2020. Long-term interest rates have increased due to expectations that the amount of monetary and fiscal stimulus, combined with a vaccine rollout, will lead to higher levels of economic growth and inflation. But we want to keep in mind that interest rates are still low by historical standards, as the 10-year Treasury yield has averaged about 3.7% over the last 25 years, and while interest rates have gone up quite a bit, they are a long way from restricting economic growth. So now if we look at a chart that shows the Bloomberg Barclays U.S. Aggregate Bond Index, which acts as a proxy for the investment-grade bond market in blue, and the 10-year yield in gray, you can see that interest rates and bond prices move inversely to each other. And the rise in yields did weigh on the bond market as the AG was down 3.4% for the quarter. Now we'll move over to the U.S. equity market. The S&P 500 increased by 6.2% in the quarter. Taking a step back, the market is up by nearly 113% over the last 5 years, or an annualized return of over 16% per year. And this is despite declining by almost 20% in late 2018 and by about 34% during the pandemic sell-off last year. So this reinforces our long-term investment approach, since we know that the stock market goes up over long periods, but that volatility and drawdowns are quite common. In the first quarter, the rise in interest rates drove a divergence between cyclical companies that are levered to the reopening of the economy and growth stocks whose current share price is heavily dependent on earnings potential, sometimes several years into the future. Cyclicals include many energy, financials, and industrials companies, while growth stocks are comprised mainly of technology, consumer discretionary, and communication services stocks. Cyclical stocks outperformed in the quarter as rates moved higher and economic growth estimates increased. Please see our latest client question of the month, which details that interest rates impact stock prices by changing the discount rate used to calculate the present value of future cash flows, the relative value trade-off between stocks and other asset classes, like bonds or cash, and the amount at which corporations can borrow or refinance. Now let's get to our outlook. The U.S. equity market has rallied over 80% since the pandemic low on March 23, 2020. And the main pillars of the rally are still in place, as the vaccine rollout and fiscal stimulus will lead to strong economic and corporate earnings growth, while the Fed is still committed to maintaining accommodative monetary policy. So let's take a quick look at each pillar. With the vaccine, the U.S. has delivered over 196 million doses, with nearly 100 million people receiving at least one dose, and about 55 million who are now fully vaccinated. For fiscal stimulus, Congress passed the American Rescue Plan, worth about $1.9 trillion, or about 9% of GDP, in March 2021. And this was the third major stimulus package passed in the last year. The Biden administration will immediately pivot to the Build Back Better plan, which could cost as much as $3 trillion total, and include corresponding tax increases. We'll have more details on the plan and the potential tax implications as they emerge. Economic growth is estimated to materially increase, with real GDP growth expected at 6.5% in 2021. The economy will likely surpass its pre-pandemic level early this year. Corporate earnings estimates are also increasing, as S&P 500 earnings are expected to rise by 25% in 2021 and 15% in 2022. And for now, the Fed has not changed their stance that they are a long way from tightening monetary policy. But our sense is that the Fed will move a bit earlier than expected, with their first step being to taper the quantitative easing program later this year. As mentioned, all the pillars of the rally remain in place, but now the stock market will begin to face headwinds caused by the economic recovery, including higher interest rates, the possibility the Fed may tighten earlier than expected, and the potential for higher taxes. We also want to highlight several signs of froth after a year of strong market returns and ultra-low interest rates, including a record number of special purpose acquisition companies, or SPACs, coming to market, a boom in cryptocurrency prices, several non-fungible token transactions going for eye-popping amounts, the volatility in GameStop, several sentiment indicators reaching their highest levels in years, and overall stretched valuations. Taking everything into consideration, we are continuing through the year with a measured approach. We were able to trim equities as the stock market rallied to new highs in the latter half of last year, and we've kept overall equity allocations close to neutral as the market continued to move higher in 2021. On the equity side, we remain tilted toward high-quality U.S. stocks, and on the fixed income side, we continue to focus on achieving balanced stability and income while accounting for short-term cash needs. And while we're certainly pleased with how the market has rebounded from the pandemic sell-off, we know that stocks do not move in a straight line forever, and volatility is inevitable. We will continue to apply our time-tested investment process based on risk management, asset allocation, and security selection as we monitor new developments and utilize any volatility as an opportunity to reposition portfolios. Thank you for watching today's video, and please visit our website at winthropwealth.com to see our latest market commentaries, videos, and client question of the month pieces.